Hi, Kuma.
Hello, Fiona. How are you?
Yes, I'm fine, thanks. How are you?
Yes, I'm good. Had a good little nap pass and came back, so 100% fit now.
How are you? So is
Uh,
it sunny out there today?
yeah, very sunny. 27, 26, nice and cool.
Yeah. It's a bit cloudy here today, so yeah, no sign of any sunshine.
All right. What's the temperature like?
Oh, yeah, very low, probably about 5 degrees or something.
Oh, wow.
Yeah, could be worse. It's quite cold in the evenings,
Yeah,
but
yeah, yeah, yeah. Yeah, now
at
it's
least it's not raining.
February. Yeah, definitely. Yeah, sure, sure. Right, we are ready for questions now.
Yes.
So I sent you two questions. Let's see how much we can do today. The
Okay.
idea is we don't need to worry about timing. We must try and get the maximum out of the question to see what the approach to answer a question.
Okay. Yeah.
Now,
That's
yeah,
Yeah, the first thing I did look at when I printed them off
okay.
was how many marks are they worth and how long in the exam would I have to spend on it?
Yeah, that's a good one because that's a good thing in ACCA. We know exactly how many marks they are giving. So I
Yeah,
always say for every 1 mark, take 1.5 minutes. That's why I
yeah,
always say every 1 mark take 1.5 minutes. So you have 100 marks. You will take 150 minutes. Keep in 30 minutes always in reserve so that you can go and plug something more in the areas what you know. Because if
yes,
you spend anything more than that one, because you have to look at the review, the wrapping up, all that kind of a thing. So always I go on the basis of 1.5 marks per 1.5 minutes per 1 mark. So
yeah,
ACCA is good because they give us the marks. For example, this question we know the first part we have 8 marks. I will only do 12 marks, 12 minutes answer.
yeah,
12 minutes. I will stop and go to the next one, next one, next one, all that kind of a thing. And
yeah,
after that, if I have more time, I see, okay, I can come and do a little bit more on the question number 1. I can do a little bit more on the question number 2. But the idea is I must attempt all the questions. I don't want to
yeah,
spend 25 minutes on the 8 marks and get stuck at the lower level, at the lower questions. I don't have time. Because our human psychology works in such a way, the very best comes up at the very first few minutes. All what we know
yeah,
will be writing. After that, we are just writing because we know or because we want to write, we write. So
yes,
the best part of the thing already it has come up. And now stop there, go to the next question. By doing
yeah,
that, what you do is you attempt every question. Because however much you do this question, you might not get your 8 marks, you might get 6 or 5 or whatever, that's it you will get, right?
yeah,
Rarely you will get the entire 8 marks, difficult to convince these examiners however much we know. So so always they give some mark. So even if you write 25 minutes, you might get 6 marks. Even if you write
yeah,
12 minutes, you might still get the 6 marks. But by
yeah,
saving that one and going and doing another answer, which you would not have got any marks, you will now still at least get 3 to 4 marks. And the idea is ultimately to get the 51 marks. No, that's all you need to get to the exam. Just get the 51 and be happy. That's all.
yeah.
Yeah.
Anything over that's a bonus.
It is already bonus, and after once you pass the exam, no one will ask you how many
No,
marks did you get. They will ask you always, did you get to the exam or not?
yeah,
So that's basically the idea. I have always worked on that plan. Of course, some, with God's grace, some students, they have done much better than what we could think of. And even they have gone to the extent of winning prizes, all that. That's a different story. But who cares? What we need is to get to the exam. After the exam, no one asks any of those questions.
No, exactly.
Yeah. Both my son and daughter-in-law, they did a MBA. Both of them have got through. My daughter-in-law, of course, has got some extra distinctions and something. My son is a little bit of a lazy man. Somehow he had got through the exam. But ultimately, both are going for the same convocation. Both will get the same degree, right? So that's it. So
Yeah, exactly.
just work it out on that kind of a thing. Only thing, you have to be very relaxed all through now till the exam. Just take things lightly and don't overstress yourself. Don't try to get into a kind of a scenario, where you lose your confidence, all that kind of a thing. No, just go. Of course, I mean, I believe 100% on God. So I always pray for my students, and I believe that there is some invisible hand also above us who can always support us in a situation like this.
Yeah.
Right. So let's start off. So the other part is, if half of your problems, 50% of your problems are solved if you can read the question and understand what the examiner is asking.
Yes.
Most of the time the problem is we write, we don't know what he's asking, and we have written something and we think we have done very well. When the results come to see, not done, to see we have not understood what she's asking.
Yes. Okay.
Reading the question is a very, very important aspect. So let's look at nowadays 25 mark questions. Take one by one, step by step, little by little. Read only the relevant section. Try to answer. Right? Don't try to
Okay.
put everything into the head and try to read the whole thing and put everything, and then even though first section is 8 marks, you are thinking the next section is 12 marks. Oh, how can I get that 12 marks? I don't know. And then even the 8 marks thing, you are not going to get it. So one at a time. That's a strategy. Right? So let's look at what the first part is. Key, a public limited company is concerned about the reduction in general availability of credit and the sudden tightening of conditions required to obtain loan from banks. There has been a reduction in credit availability and a rise in interest rates. So remember, this was something in 2007, 2008 when the recession was there. This was the scenario. But even now we can see it is happening. It seems as though there has ceased to be a clear relationship between interest rates and credit availability. Lenders and investors are seeking less risky investments. Lenders are looking for less risky investments. Investors who want to invest are looking for less risky investments. At certain times, we see lenders, of course, always look for less risky investment. But at certain times, we see investors, when the share market is doing very well, they will be taking some risk and going for some risky investment. But at various times, due to certain lessons they have learned, or companies have collapsed and all that, the people, the directors, everyone will be very, very focused, concerned to go for less risky investments. The directors are trying to determine, that is in key company, the practical implications for the financial statements, particularly because of large write-downs of assets in the banking sector, tightening of credit controls, and fall in sales and asset prices. They are particularly concerned about the impairment of assets and the market inputs to be used in impairment testing. So remember, we discussed this IS 36 about the impairment testing. So financial statements are a very important tool if we are going for some bank facility, etc. Right? One reason why we prepare financial statement is to give useful information for various users of financial statements to make sound economic decisions. That's one of the reasons, or the main reason, why we prepare financial statements. So the bankers, in a very particularly in a tight credit situation, will be looking all the time for the financial statement. They are particularly concerned about the impairment of assets and the market inputs to be used in impairment testing. They are afraid that they may experience significant impairment changes in the coming financial year. They are unsure as to how they should test for impairment and any considerations which should be taken into account. They are afraid they may experience significant impairment changes in the coming financial year. They are not sure how they should test for impairment and consideration which should be taken into account. So a lot of stuff is given. But now look at only the 8 marks. Don't even look at the other part. Discuss the main consideration the company should take into account when impairment testing of non-current assets in the above economic climate. So now look at simply, you can see, because sometimes whether you remember the impairment test can come up mainly due to 2 areas. One is the external situation, external indicators, and also internal indicators. So these are the main consideration the company should take into account when impairment testing non-current assets in the above climate. So let's look at what are the things that we should be looking at. So basically you must always, okay, any points that you have, Fiona?
Okay, so looking at the question, discuss the main considerations that should be taken into account. So I would start by talking about the external and internal sources and how that might affect this particular business. So the internal sources would be there's a worse economic performance than they're anticipating. External sources would be obviously the current market at the moment is in decline. The interest rates, there's a rise in interest rate, so it's all going to have an effect on testing for impairments.
Basically, you are the accountant here. It's like a case study. Your finance director, some person is asking, hey Fiona, discuss the main consideration that we should take, because they are considering, they are afraid they may experience significant impairment. So what are the considerations that the company should take? So first thing we must talk about is the basic principle of IAS 36. What is the basic principle of IAS 36? The impairment of assets, that no asset should be carried at anything more than its recoverable amount. That's the basic idea, right? So that is the main factor you must consider. IAS 36 impairment of assets states that no asset should be carried at anything more than its recoverable amount. And the recoverable amount is the amount to be recovered through use or through sale of asset. Recoverable amount is the amount to be recovered through use or sale of assets, or by the sale of asset. If the asset value is higher than, if the carrying value of the asset is higher than the recoverable amount, then an impairment has occurred. If the value of the asset is higher than the recoverable amount, then the impairment has occurred. In such case, the impairment loss should be written off against the profit or loss for that particular year. As a company, on each reporting date, we must determine whether there are any indications that impairment has occurred. Indicators of impairment could be external, could be internal. internal indicators, internal factors may arise irrespective of the environmental, irrespective of the economic climate. And internal indicators may be physical damage to the asset, adverse economic, physical damage to the asset, adverse changes to the methods of the use of the asset, differences arising due to management restructure, or overestimation of cash flows. Now, any of these could be internal indicators. The first one what we discussed was about a physical damage. Obviously, that will reduce the value of the asset. Second one is all about is arising due to the adverse changes to the method of use of the asset. Earlier, we were using the asset very much, but now because of the new machine that has come up or the new technology that has come up, we are not using the machine as much as we used it earlier. So that could be another reason. Third one, management restructuring. We have restructured the entire business and this asset is no longer a kind of a useful asset for your company. So that could be another one. Or overestimation of cash flows. We have already worked out the value in use through cash flows, but now we realize, oh wow, we have thought that we can get 100,000, but whereas now we see it's only 40,000. We have provided for the second year 150,000, but now we see only 60,000. So these are internal factors that will have an impact, and these are the indicators of internal factors. Then we come, particularly when the economy is somewhat adverse, like in our case, then there are additional external indicators that is very likely to be evident. Like in our case, like in this case. So what are the external indicators? Significant decrease.
Right.
Yeah?
Yeah, so I was just the rise in interest rates.
Yeah, the rise in interest rate, the drop in credit availability, those are very adverse economic indicator because the companies cannot survive without money and the companies cannot survive by paying high interest. So those adverse indicators surely will reduce your cash flow and will reduce the usefulness of the asset.
Yeah.
So a significant decrease in the market value of an asset in excess of normal passage of time. It can be something again due to technology, maybe because of the economic climate, because it may be because of the better economic climate sometimes, your machine is now becoming outdated. So it is becoming decrease in value very fast compared to what it was earlier. Significant changes in the market or business where the asset is used. You remember the 2007 time when the credit crunch came, it's not only affected the business, it affected the individuals. Because today, if you look at the world, most of the individuals, we also live with credit cards and all that kind of a thing. Suddenly tomorrow morning, the credit card company says, hey, your limit is restricted to 20% of what you are using, we will get stuck. Right? So it's not only the businesses, even the individuals. So we will not be able to buy what we were buying, whatever they were buying. Only the essentials we will buy. We will not have any money to travel. We will not have any kind of go for holidays. We probably will spend on medicine and all that kind of essential one. Adverse changes to the technological, economic or legal environment of the business. Now, our president of the country has suddenly got up one day early morning and announced in Sri Lanka, the most of the housing roofs are asbestos sheets. Someone has told him that it is very cancerous and something. He got up early morning and he said, from next year onwards, no more asbestos sheets. Imagine the people who have invested so much of money in the business of manufacturing roofing sheets. Suddenly, they get up in the morning. The president has got up from the other side of the bed, and when he announces something like that, what can they do? The asset what they bought for millions is worth zero.
Yeah.
So that can happen. So even at the moment they are negotiating, but that man has already made a statement. He can't go back by the statement. So it's a big issue, right? Sometimes this food, the people. Today the doctors say for cholesterol eggs are good. Tomorrow the doctors say eggs are not good. Day after tomorrow they say something. So whenever those things are told, suddenly there is a kind of excitement in the market.
Yes.
Our president, we have a new president of the country. He's a very simple, humble man, but he is trying to change the whole thing overnight life. So the tobacco manufacturing company, which is one of the largest revenue earners for the business world, the corporate sector, he has said, in the cigarette packet, you have to put 80% of your cigarette packet should say that smoking is cancerous, all that kind of a thing. And with that kind of a thing, when it goes, surely the market drops. And, true enough, I mean, they're bad things. But for the business world, it's a different story. They have invested money, they expect it to grow, and suddenly your president or prime minister or some person comes up something, the government legislation can have a massive impact. Increase in market interest rates. The moment the market interest rates are increased, what happens is the discounting rate for the cash flow, right? The discounting rate for the cash flow to get the value in use is basically the cost of capital for you. That is the discounting rate we use. When the rates goes up, what happens to the discounting rate, Fiona? When the interest rates goes up, yes?
The net present value of the cash will be lower. Yeah,
because the discounting rate is higher, and therefore the cash flow rate, the net present value will be lower. Very good, lower. So your value in use will come down. Value in use will come down. Then when the interest rates increases, adversely affecting the recoverable amount. So that can happen, right? When the interest rates increases, it will affect the recoverable amount because you can't sell the asset because there is the cost of finance is so expensive. People don't want to buy any machine. So your second-hand machine also they don't want to buy it. So these are the main reasons, the internal and external factors what we have to look at. So generally it should be looked for always for individual assets. So now here discuss the main consideration should take when impairment testing non-current assets in the above economic class. So this is another point I want you to note it down and write down in an impairment case. Generally, the impairment should be done for the individual asset. Individual asset. However, if it is difficult, it can be taken for a group of assets for a cash generating unit. Now this is also provided in IAS 36. Without taking the individual asset, you can take the entire assets of the Ceylon Tobacco Company in Sri Lanka because of the president's remarks, because of the president's adverse thing, the entire cigarette manufacturing, that machinery will have an impairment.
Yeah.
The entire asbestos machinery, including the packing and brand, whatever, will have an adverse impact. So you must look at individual asset ideally, but in a situation where it is difficult, you can look at one cash generating unit and you can do the impairment review on that basis.
Yeah. Okay. So
Yeah.
in this, in case of what you're just talking about, that would be the option.
Yeah.
To use them as a group rather than individual, because they're all affected.
Yeah. Ideally, the individual asset should be impaired tested for impairment. Where it is difficult, you can take the group of assets for a one cash generating unit.
Yeah. Okay.
I mean, you can't take the entire company because the company may be involved in many different activities. Now, for example, the Sri Lanka, the asbestos manufacturing company, they are producing many other products. So, not the entire company's assets are impaired. It is that particular unit assets are impaired.
Yeah.
So,
okay.
Also IS 36 go a little bit more to say what is the recoverable amount. Recoverable amount is defined as the higher value between the asset fair value less cost of disposal, which we call net realizable value, assets cost less disposal, cost of disposal, which we call net realizable value, or the asset value in use, higher of that.
Yeah.
The asset value in use, you remember, is the present value of estimated future cash inflows minus outflows.
Yeah.
Discounted at the cost of capital rate, considering the time value of money. So these are the things that we will be looking at. So I think for the answer that is good enough, but just because we are in the question, whenever there is an impairment to be done, the impairment is not a very easy thing. So that can be another question. The impairment is so difficult, how it could be supported. So one thing, it will be supported with reasonable and supportable documents. You have to show that because of these reasons there is an impairment, something like that. Because of the President's announcement, no more market from 2020 for asbestos, and therefore there is impairment.
Yeah.
So you have to give some support kind of a thing. IS 37 specifically requires the specific reasonable and supportable documents and cash flow projections up to 5 years. Cash flow projections up to 5 years should be based on the most recent budget and financial forecast.
Okay.
In a time of a recession like what we have seen here, the cash flows should not be overly optimistic.
Okay. So the ACCA, the answers to these questions, I'm assuming you'll send to me later.
Yeah. Yes.
Yeah. Cool.
Okay. This is the kind of answer. I will try to write an answer for you and send it, but I want you to pick up these points so that, depending on the minutes that you have, you will write as much as possible. But at the 12th minute, you will stop it. But I'm not going to stop it at the 12th minute because I'm trying to give you the best possible knowledge through this kind of a question. Yeah. So that is what we should be looking at. So in an adverse economic condition, climate, the entity will need to consider the market in which it operates and see particularly whether the comparable industries in that industry environment, whether they are providing for impairment. Now imagine you and I, all of us are in the asbestos sheet industry in Sri Lanka. Our president has made an announcement and I and the other companies are providing for impairment. You are not providing. So in that case, you must explain why you are not providing. Explain the absence of such impairment changes. What could be the reason that you are not providing, Fiona?
Okay. Well, if it's not going to happen for another 4 years, there is no impairment in the current year.
Yeah, you might say immediately there is no impairment, but again, it's a little bit of a risky thing, because we are looking for impairment not today. We are looking to the value in use. Value in use. When we look at to the value in use, we have to look at future 5 years at least cash flows.
Right. So yeah, looking ahead 5 years, it would come to that period.
It will come to that one. It will come to that one, right? Of course, as I said, it is the higher of the two. But if you feel that you can get still a realizable value, a higher figure, and it's much more than it's much more than the carrying value, then you don't need to provide.
Okay, and I guess once that announcement's been made anyway, no one would want to buy that equipment.
Exactly, you're right. You're right. But of course, it can be a scenario like this. You may not be producing it for Sri Lanka.
True. Yes. So it may be
producing not for Sri Lanka. So the Sri Lanka President statements will not apply to you. You are producing in Sri Lanka for Bangladesh.
Yeah. Okay.
If that happens, you don't need to. So I mean, I'm thinking about various scenarios that can come up in questions.
Yeah. Okay.
So even though others are providing, because all the others are local sales, so they have an impairment. But I don't need to provide for impairment because I'm not producing for the local market. The local president's statement has no impact upon me. I have got a market for next 10 years in Bangladesh. Bangladesh president has not told she's going to stop it.
Yeah. Okay. Yeah.
So always you must remember that testing for impairment is a very, very time-consuming activity.
Yeah.
And you must very carefully consider the discounting rate whenever you are doing the value in use. The discounting rate need to reflect the risk. Higher the risk, higher the discounting rate. Those are the factors you should be looking at.
Yeah.
I think that I have fairly covered up all that area. So you can see you get 2 marks. For professional, marks will be awarded in part for clarity and expression. So that's a very 2 important marks. You must write in such a way, in a beautiful presentation, so that you get that 2 marks.
And I guess that would include things like mentioning IAS 36.
Yeah, mentioning IAS 36, the higher amount of the recoverable amount is the higher, all that. Put it in bullet forms nicely and write it, you get the mark. Don't try to overcrowd. Don't try to, write something here, then again write something there, because that's not good. Try to write it in a flow. Your exam will be a written exam, no?
Yes, it will be.
Is it computer-based or written?
It's written.
Right, okay. So there you have to be more careful, because, don't have too many cutting and chopping. Just go and do it, and then you might be collecting marks. Right, so that's good for the first part. Shall we look at the second part now? The specific assets on which the company wishes to see advice. Company holds certain non-current assets which are in a development area and carried at a costless depreciation. These assets cost 3 billion on 1st January 2003 and are depreciated on a straight line basis over their life period of 5 years. An impairment review was carried out on 31st May 2004, and the projected cash flows relating to these assets were as follows. So if I were you, I will note down the date. When was it bought? 1st June 2003. And impairment review was carried out 31st May 2004. That means just after 1 year. Just after 1 year. 12 months later, they are carried out. And also they are given the next 5 years, 1, 2, 3, 4, next 4 years, the value in use, to calculate the value in use, they are given the cash flows. Company uses a discount rate of 5% at 30th November 2004. So 31st May, 6 months later,
Yes.
right after 1 year, 6 months later, directors use the same cash flow projections and noted that the resultant value in use was above the carrying amount of the asset and wish to reverse the impairment calculated at 31st May 2000. So 31st May 2004, they impaired it. IS 36 provides us later on, if we find that the asset has gone up in value, we can reverse the impairment.
Yeah.
We can reverse the impairment only up to the amount we have impaired. We can't reverse it more than that. So that's what it says. The government has indicated that it may compensate the company for any loss in the value up to 20% of the impairment loss. So the government is a good government. Key holds a non-current asset which was purchased for 10 million on 1st December 2001 with an expected life of 10 years. On 1st December 2003, it was revalued to 8.8. At 30th November, asset was reviewed for impairment, written down to its recoverable amount of 5.5. So you can see two transactions. One is about this 3 million asset. Second one is all about 10 million asset what they have purchased. He committed itself at the beginning of the financial year to selling a property that had been underutilized following the economic downturn. As a result of the economic downturn, the property was not sold by the end of the year. Asset was actively marketed, but there were no reasonable offers to purchase the asset. He is hoping that the economic downturn will change the future, therefore not reduce the price of the asset. So there are three transactions here. One, a 3 million transaction. Second one, a 10 million asset. Third one, it's all about a property with no figures are given, but which is subject to the economic downturn. Discuss suitable conditions, how to account for any potential impairments of the above non-current assets. I want you to note that word non-current assets, the last is. So because there are three transactions in the financial statements for the year ended 30th November 2004. So 30th November 2004.
Yeah.
And they are given the discounting factor. So we have 25 marks here. The 25 marks for the total question. Already 8 and 2, 10 gone for the first part. The three parts here we have 15 marks.
So you're probably looking at 5 marks per section.
5 marks per, exactly. So 5 marks means 7.5 minutes is the time. If you spend all the 15 minutes on the 22 minutes on the first question, first part, you will not be doing anything good in the second and the third. So you have to work out a strategy. You are going to look at 7.5 minutes for the first part. So the first part, what the question what we have is suitable calculations, how to account for potential impairment of the non-current assets for the year ended 30th December 2004. So this asset was bought on 1st June 2003. Right? 1st asset June 2003. So on 31st May 2004, can you work out the carrying value first of all? That's the first thing. What is the carrying value at the end of 31st May 2004? Assuming it is going over a period of 12 months, at the end of 31st May 2004, what will be the carrying value? What is the estimated life period of the asset?
3 million less 0.6.
That's correct. 3 minus 0.6, 2.4 million is your carrying value. Right? Now can you calculate on 31st May 2004, because they are not given the realizable value. So we only have the value in use. Can you calculate the value in use for this asset? So simply you look at the 280 450, 500, 550. Apply the discounting rate. Discounting rates are
Yeah.
given 0.524, 0.9070, 0.863, 0.8227. And you quickly calculate the value in use for this asset as at 31st May 2004. $280 into 0.9524.
Yeah, 171.43.
How much? That's the carrying value. No, I got some different figure. 280 into 0.9524.
Oh, 280 or
Yeah.
0.8.
280 into 0.9524.
Oh, 2.66.
Yeah. How much? 2.66, no? 2.7. 2.67.
Rounded up, yeah.
Yeah.
2.7
Yeah.
rounded up, yeah.
Then 450 into 0.9070. 450 into 0.9. So if you have a scientific calculator, you can just go and calculate in one shot the whole figure. You don't need to take separately figures. 280 into 0.9524 plus 450 into 0.9070. Then 500 into 0.8638.
$3.2.
Yeah. Then 550 into 0.8227. 550 into 0.8227.
4.5.
4.5. That is 452. Right. So what is your total? Yes. Okay. What is your total value of all that figure that is coming up, Fiona?
14.5.
14.5. 14,
Yeah.
14 or 15.5? 2.6. First one was 2.6, was it?
Yeah, 4.1, 3.2, 4.5, 14.5.
Yeah. Just a minute. Where did I go wrong? 2.6. 2.6 plus 4.0. Then 4.3 plus 4.5. 15.4. How much you are getting?
I think the third one's different. Hang on.
Yeah, 500.
Oh, yeah.
Yeah.
I've written the wrong number down.
Okay,
so
okay.
8638.
Yeah.
Okay, no, I'll just recalculate that one.
500 times 8.8638.
Yeah, 4.3.
Yeah.
So that should be 4.3.
Yeah.
So that then makes that 15.6.
How much? 15.6, correct.
Yeah.
15.6, right? What is
Yeah.
the asset? So 15.6 is the value in use. What is your asset value? The carrying value? Yeah. Now you have a problem because you calculated. Yeah. Yes.
At which date?
That is 31st May 2004. We are still on 31st May 2004. We calculated the value. You said 2.4, isn't it?
Yeah. Yes.
Yeah. Now what happened was that calculation you said 2.4 million. This calculation you did it rounding up the figures. Actually, the figure that you are getting is not 15.6. It is 2.6. 2.64 million. 4 and 4.3 and 4.5. All that are actually not 2.6. It is 0.26, 0.40, 0.43, 0.452. Because when you multiply 280 by 0.925, 9524, actually what you are getting is 267. So good. Rather than putting up the figures 2.6, put the whole figure. Otherwise you might get misled. 280 times 0.9524 is 267. Right?
Yeah.
450 times 0.9078, 408. 550 times 500 plus into 0.8638, 432,000. 550 into 0.8227 is 452,000. So when you get that one, what you get is 1559. That you got us correct, 15.59. But 1559 is the figure, 1,559,000. What is your carrying value? 2,400,000.
Yeah.
Now you can see the impairment. Because otherwise if you put that figure 15.59, you might not see the impairment. Now you can see the impairment.
Yeah.
The impairment is the carrying value is 2,400,000, 1.559, and therefore there is an impairment of 841.
Yeah.
So that is what you will be writing off, or that is the impairment that you will show on 31st May 2004. Right?
Yeah.
31st May 2004. Now they are basically thinking so that is the impairment that you will do it on 31st May. And now look at what they say. At 30th, the directors use the same cash flow. Now that's the very important word. Same cash flow projections, and noted that the resultant value was above the carrying amount. Now, if there is a change in the economic climate or the internal climate or whatever it may be, it cannot be the same cash flow. Agree?
Yes.
So if they are using the same cash flow, and in that case if the same cash flow is going to be used, how can it go up now, Fiona? If the same cash flow is being used, now earlier with using the same cash flow we got 1.459, 1.559. If the same cash flow is being used, now can they get a higher one?
How can it now be? Well, if the asset's been damaged or
no, same cash flow. Same cash flow means the value in use what they are getting is the same. They are getting 280, 250, 500, 550. No change in the figures. So my question.
Oh, sorry. It means the cash flows are higher.
How can the cash flow becomes higher if it is the same cash flow? They are putting 280, they are putting 450, they are putting 500, 550. How could it be higher now, the present value?
Well, it can only be higher if they've reduced the discount.
Yes. If you reduce the discounting rate, isn't it?
Yes.
If you reduce the discounting rate, it can be higher. But IAS 36 does not permit that kind of a reduction of discount rate and making the cash flow, making the impairment test carried out. Understand? Right? IAS 36 does not give us the facility to unwind the discount rate. IAS 36 does not permit us to unwind the discount rate, and therefore it cannot be reversed. So second part, you don't need to calculate. You only have to say with the same cash flow, the only way the company can get a better cash flow is to lower in the discounting rate. IAS 36 does not permit to unwind the discounting rate, and therefore it cannot be accommodated.
Right, okay. Yes, it's very easy to mislead in an exam condition,
because
isn't
you
it?
might want to calculate another one and do all sorts of things if they are given some figures or something like that. you might go over the top. So you must know exactly what the IAS 36 is saying. IAS 36 says same cash flow. No, very sorry, you can't do it. If the economic environment has improved, the cash flow should improve. In that case, it's a different cash flow. You can do it.
Yes.
Right. So that's that part of the question. Then we have about this government trying to give a 20% impairment loss. The government has indicated it may compensate.
Yeah.
So how to account for that one? Now, the words that I want you to clearly note down is the government has indicated it may. So remember we discussed IAS 37, the provisions, contingent liabilities and contingent assets. So here it's something like a contingent asset. The government may give. Government may give. It's not yet decided. The government may give. So if we receive the money, we can treat it as a separate economic event. But no credit can be taken for the compensation at this moment of time because the government is not very certain. It only says it may reimburse.
Yes.
So therefore, that is the answer for that one. So even though the question looks very low, big, you just have to answer like that one. One sentence, and you can and you can do it. Now let's look at the second one. The key holds a non-current asset which was purchased for 10 million. 10 million on 1st December 2001, which was expected to have a life period of 10 years. On December, it was revalued to 8.8. Asset are reviewed for impairment, written down to recoverable amount of 5.5 million. So how to work through that one? How to work
so
through
we're 2001, 2002, 2003, 2004. So it's had 3 complete years.
Yeah, the 1st December 2001. How many completed years before the revaluation?
None, because it was bought 1st of December 2001.
Yeah. So how many completed years as at 1st December 2003?
2.
So 10 million asset, life period is 10 years. So every year it will be 1 million. So after 2 years, the book value would have been 8 million, correct?
Yeah, 8 million, yeah.
And it was revalued to 8.8 million.
Yeah.
So revaluation reserve created for 0.8 million. Correct?
Yeah.
So now the new value of the asset is 8.8 million. No change in the life. So now for the balance 8 years, it will be depreciated 8.8 divided by 8, 1.1 million every year.
Yeah.
Right. So after that, now there are how many years? As at 30th November 2004. So this was on 2003. After that,
so 1 year.
1 year.
Yeah.
So 8.8 minus 1.1, 7.7 will be the figure.
Yeah.
7.7 will be your carrying value. And when it was impaired, reviewed for impairment, the recoverable amount is 5.5. So you have a impairment 7.7 minus 5.5, 2.2.
Yeah.
Now that 2.2, we can go and reverse what is in the revaluation reserve up to the amount that is available in the revaluation reserve. So out of 2.2,
which is
0.8 we can take it through other comprehensive income and we can take that out. The balance 1.4 million need to be charged to the P&L.
Yeah.
That's all we need to do. Very simple. You have to first look at 8 million. Okay, 8 went up to 8.8. So in the revaluation reserve, there's a 0.8 million. And after that, another 1 year gone, 7.7 is the carrying value. The recoverable amount is 5.5. So there's a 2.2 million impairment. of that 2.2 million impairment, we can reverse 0.8, 1.4 million we charge to the PN.
Yeah.
That's all we have to do.
Okay.
So that's the next part of the question. So you can see that one probably will not take even 5 minutes. So you can quickly finish it up and go. Then we have the next area, property to be sold. Right? Property to be sold. So here, last paragraph, you read it carefully. What is the accounting standard they are looking here? He committed itself at the beginning to sell a property that had been underutilized following the economic downturn. As a result of the economic downturn, the property was not sold by end of the year. Asset was actively marketed. There were no reasonable offers. He is hoping that the economic downturn will change and therefore has not reduced the price of the asset. So there is surely the plan to sell the property because it was underutilized. So there was definitely the indicator for impairment.
Yeah.
Right. So there is it's a kind of a cash generating unit, and it was tested and it was there. So whenever we have a non-current asset which we have decided to dispose, we can apply the IFRS 5. Remember the IFRS 5? Non-current assets held for sale and discontinued operation. Right? You remember that standard?
Yes.
Right?
Yeah.
So that standard has certain criteria. If those criteria are met, we can put that asset, whatever we are going to sell it, under just below current assets as non-current assets held for sale. We don't need to keep it under non-current assets. We can bring it down, keep it just below current assets under IFRS 5 as non-current assets held for sale.
Yes.
Right. So here now we have to see whether we have got the criteria. What are the criteria that you need? Management must be totally committed to the sale. Here we can see they are totally committed to the sale. Active program to locate a buyer must have been initiated. So the asset was actively marketed. So that criteria is also met. Right? The market price must be reasonable in relation to the asset's current value. Now probably that criteria is not met because was marketed, no reasonable offers, and they are not going to change the price. You understand?
Yeah.
Right?
Yeah.
So that criteria is not met. The fourth criteria, sale must be expected to complete within 1 year from the date of classification. Right? So far we are not classified. So the day that we classified under IFRS 5, we can. But the question is, can we classify it under IFRS 5? Can we classify? We cannot classify because the market price should be reasonable in relation to the current fair value. So we have advertised, we have not got the near price and we are not prepared to change the price, and therefore we have not fulfilled the criteria.
Yeah.
So therefore this asset cannot be shown under non-current assets held for sale under IFRS 5.
Yeah. Okay.
So it will not be applied. So because they have not reduced the price and therefore it is in excess of the market value, and therefore it cannot be classified as a held for sale. But if impairment has taken place, the recoverable amount would be the fair value, less cost to sale. Because it will not have value in use now. Because they are not going to use it now. So they have to compare, for the impairment purposes, they have to compare with the recoverable amount is the selling price minus selling cost against the carried value. They have to compare and provide for any impairment. Is it clear?
Yeah. Yeah.
Right. So this is a good answer we did with all sorts of things, so many things. So probably you will be writing answer again, taking all the matters in your own way. You will write it to see whether you can get the answer.
Yeah.
And send it to me. I'll go through that one and correct it for you.
Okay.
So tomorrow we have another lesson. We have another question in your hand. I think it is on consolidation if I remember right.
Yeah.
Shall we look at that one tomorrow?
Yes, okay.
Yeah. So we will look at that one. So the question what we did today, you can look at the recording also and try to answer. Now you can time it.
Yes, okay.
Now you can time it and see what you are going to include, what you are not going to include, and try to see how you best you can do it. Because we discussed a lot of things from the question, so you know now what need to be done. Okay?
Yeah. Okay.
Shall we make tomorrow then? We'll meet tomorrow and we will look at the next question also.
Yes, okay then.
Okay, thanks Fiona. I'll see you tomorrow then.
All right, thank you.
Thank you. Take care. Bye. Have a great day.
You too.
Bye.
Bye.